right, Matt. Today we are talking about how much of our income we can write off with charitable donations. I think an important topic, especially for those who are charitably inclined and want to make donations maybe now from a business sale or something other, or in the future. You have to know the rules because there's certain limitations as to how much you can donate and exactly what assets you can donate. And interestingly, I think some people are kind of somewhat familiar of the rules, Matt. Maybe people know that you can donate up to 60% of your income in cash and maybe 30% of your appreciated stock of your income in appreciated stock. So we ran across a situation where someone thought that they could offset, 60 plus 30, 90% of their income, basically write off all of their income in a year, in a high tax year, just by donating to charity. And unfortunately for them, they got bad instruction from their CPA and did this, and then of course found this out after the fact. So this is why we wanted to cover this topic, to kind of set the record straight and give you guys some information that you can use. So there's two types of charities that you can donate to, and the IRS has given them very clever names. The first one is called a 50% limit organization. And the second one is called a non-50% limit organization. Very, very IRS of them to label these as such. Okay, so what are each of those? So a 50% limit organization, that is what you would think of as a normal charity. So think of churches, universities, any public charities, any 501c3s that, come across as you go about your day, or even this is a big one, Matt. Donor-advised funds are 50% organizations. I'm sure you're wondering, Matt, or anyone else, why are they called 50% limit organizations? What is the name with that? Well, it had to do back in the day, pre-2017, before the Tax Cuts and Jobs Act, when you were actually limited to 50% of your AGI. So your donation was limited to 50% of your income. That was the maximum deduction that you could get. So that's why they're called 50% limit organizations. Even though now it's no longer 50% if you are donating cash. It's actually 60%. But the IRS still kept the name as a 50% limit organization just to confuse everyone. So that's a big distinction that people need to remember, that it's, even though you're donating to a 50% organization, it may not be the limit. It might actually be 60% if you're donating cash. We'll talk about that in a second. Now, a non-50% organization, so this is mainly, think of this as private foundations. So nothing public, no 501c3, that type of thing. So this isn't your Salvation Army or St. Jude Children's. This would be a private foundation. Probably a big name maybe that you're familiar with is the Bill and Melinda Gates Foundation. That's obviously a big one. The Rockefeller Foundation. They're usually set up by individual families or corporations, but it doesn't have to be someone with mountains and mountains of dollars to set up a foundation. Even smaller families can do it. Maybe they've sold a business, they have some money they want to set aside to a cause that they care about. Usually kind of the cutoff for what would make sense for a private foundation is usually if you're going to donate north of $1 million to it, just because there's a lot of administrative expenses and that sort of thing that come with it. So just wanted to share, I guess, really briefly here, just kind of a real life example of family foundations. So the best place to probably look at these and find them is looking at a local university. So we'll jump to the alma mater here. So here we are at Southern Methodist University's gift page. And if you look over here to the right, looks like the Baugh Foundation granted $1.8 million to the Baptist House of Studies in the School of Theology. Come down here, looks like the Spot Family Foundation has announced a $2 million gift to the Meadows School of the Arts. So these are all family foundations or personal foundations or private foundations, if you will. Obviously, if you looked on any university's website, they would all have this information as well. But those are private foundations kind of in the wild, if you will.
Yeah, and one distinction there, Stephen, is there's actually two types of private foundations. There's private operating foundations, which are organizations that actually run charities themselves. So like museums are the most prominent example. And then family foundations, like you're talking about, are private non-operating foundations, which really just exist for grant making to other charities. And so that's what we're talking about here for listeners and people out there thinking about charitable giving, and especially, like you said, $1 million plus increments. Then opening your own private foundation would be starting your own private non-operating foundation. And so, Stephen, talk to us then, I guess, just to summarize and hammer it home, the 50% title that the IRS came up with, which, like you said, is not the most original title that's ever been given. So how that plays out is for someone who has $100,000 of income, they can deduct up to 50% of that income. And so therefore, they can reduce their taxable income by $50,000 through charitable giving up to that limit. Am I thinking about that right?
Sort of. So this I think gets into the second point, is it depends on what type of asset that you give, Matt.
Okay.
So good question. So there are three main assets that one can give: cash, non-cash, which think of that as, clothing, jewelry, if you donate a car, kind of real property, things that you would typically give to Goodwill or something like that. And then the third thing is appreciated stock. So anything that has gone up in value and there's a gain in there. So we have basically two types of charities: 50% organizations, non-50% organizations, and then three types of assets. And those all intermingle. And basically the IRS has broken this down and said, hey, there's basically 5 categories that you can give to that have these certain limitations depending on what asset you're donating. Okay, so the first one, let's talk about if you are giving cash to a 50% organization. And the AGI limit is now 60%. So this is an update. This is why the name is all confusing. So this is probably the most popular thing that you will see if you donate to a church or a school. You donate cash to it. If your income is $100,000, you can deduct up to $60,000 off of it on your return. So that was number one. Number two is non-cash donations to 50% organizations. And this has a 50% AGI limit. So not 60, now 50. This is probably the least used category, Matt, just because, it's typically household items, clothing, cars, that sort of thing. You're not really donating that much to offset half of your income. But that's the limitation. 50% of your income can be donated of a non-cash item. So that was number two. Number three would be, and here we're getting into the non-50% organization. So if you donate cash or clothing or that sort of thing to a non-50% organization, you are actually limited to 30% of your AGI. So if you're donating to your own private foundation, maybe you sell your business for cash and you're putting some money in there, you are limited to 30% of your income in that year. Okay, the last two categories, number 4 and 5, have to deal with appreciated stock. So if you're donating appreciated stock to a 50% organization, that is at a 30% AGI limit. And this 30% limitation applies when you are donating appreciated stock. And important caveat here, you have to have held this stock for at least 1 year. So don't, buy something, it goes up in value, and then immediately donate it. That's no good. You have to wait at least a year. So it has to be long-term capital gains is the distinction here. So this can be stocks, it can be real estate, it can be artwork, something like that. But the big benefit here is not only do you get a deduction, not only do you get a 30% deduction, or up to a 30% deduction on your taxes, but you also don't pay the capital gains tax. So you get a double benefit, which is very powerful, and why this should probably be the first place that you look to donate from. So instead of donating cash, you should look to donate appreciated stock or any other item that's appreciated, because you don't pay that capital gains tax, which is pretty powerful. And then lastly, if you're donating appreciated stock to a private foundation, a non-50% organization, that is a 20% AGI limit. One last thing is that, say if you donate more than the limitation, it doesn't mean that you lose that money or lose that deduction. You can actually carry forward the deduction up to 5 years. So if you donate, a whole bunch of appreciated stock in 1 year, maybe your AGI is $1 million, you donate $1 million worth of stock, you're limited to 30%, but you can carry forward that extra $700,000 for the next 5 years. So it doesn't go away, but it is limited, obviously, by that AGI limitation.
Yeah. And so I guess just jumping back to something you said, Stephen, to finish the point on the holding period difference for long-term capital gains property being the key. Am I correct, Stephen, that if you donate before the 1-year holding period, i.e. you're donating short-term gain property, you actually only get the deduction for the cost basis of the property, so the appreciation goes away from a tax deduction standpoint?
Yep, exactly. So don't do that.
Wait a year if you're going to give it away. Totally.
Yeah.
No, that's helpful, Stephen. Just want to make sure I was thinking about that right, and our listeners had that clarification as well. So, Stephen, what were the impacts, if any, from the tax bill that passed in the summer of 2025, the big, beautiful bill on any of the stuff that we're talking about?
Yeah, there was a couple things that changed. So starting in 2026, these charitable deductions, if you itemize on your tax return, you're actually limited up to the 35% bracket. Now, the tax bracket's actually, the highest bracket is 37%, but they basically cut you off there. If you're in that highest bracket, you're limited to just 35. You only get a deduction up to 35%. So that's a kind of a big deal there for high income earners. But I think that this will apply to most folks, is that there's a new floor for charitable deductions. So this year, starting in 2026, charitable donations below, this is kind of funky, but 0.5% of AGI will not be deductible. So it's best to give an example to flesh this out. So say a taxpayer has $200,000 in income and gives $10,000 in charitable giving. The first $1,000 of that charitable giving would not be deductible. So 0.5 times 200,000, their AGI, equals $1,000. So 1,000 of their 10,000, they can't deduct. So only $9,000 is actually deductible. Kind of interesting how the change that this brought about. And then the last thing is that, remember we're talking about the names, how you can donate cash and get deducted 60% of your income. The OAAA made that permanent. That was just supposed to be temporary, but it made it permanent. But it still maintains a 50% limit for non-cash contributions. And that's very confusing when I say that. And I think that the best way to do it is to show you guys an example. And because I think this is where the CPA got stuck, and certain people can get stuck as to actually how much can you deduct if you're giving cash and maybe appreciated stock. So let's jump in and talk about an example here. Okay, so here we are in our tax software. We have our client here, Ryland Grace. Shout out to Project Hail Mary. But he has earned in 2026 $1 million spread around between wages, some interest, dividends. His total AGI, if we come down here, is $1 million, just to keep things straightforward and simple. So I'm going to kind of run through 3 scenarios here. So what happens if he donates $600,000 of some asset? And our first example will be him donating $600,000 of cash. So let's come here and see how this breaks down. So you can see the 5 different categories that you can use. If you're donating $600,000, remember, of cash to a 50% limit organization, so a public charity, you get capped out at 60% of your AGI. So that's why he's trying to maximize his donation here. But with the changes that happen in the OAAA, the new floor comes in. 0.5% times $1 million means he has a $5,000 floor. So $5,000 of his $600,000 doesn't get deducted. So his actual deduction is $595. Okay, so let's look at scenario 2, where he donates cash and stock. we're going to cap him at $600,000 of total donation. Let's say that he gives $300,000 of cash to a 50% organization, and then $300,000 worth of capital gains to a 50% organization. So same total, $600,000 as last time, but what do we have here? He's not able to write off the $600,000 minus obviously the AGI floor. So he's only able to deduct $495. And you can say, okay, Stephen, what in the world? We're within the 60% AGI limit, right? And we're within the 30% AGI limit for capital gains. How come we can't write off the whole thing? Well, it's because the total amount of gifting, if you are donating appreciated stock, combined with any cash donations, get capped at 50% of your AGI. So if you are donating any type of appreciated stock plus cash, it gets capped at 50%. So even though the AGI limit for cash is 60%, if you split it up, then it gets capped at 50. So you can only write off the $500,000, and you have a $100,000 carry forward from the capital gain position that you were donating. So important distinction there.
And the way that carry forward works, Stephen, am I correct that if he doesn't make any donations next year and he has the same $1 million of income, he will get credit as if he made a $100,000 donation next year?
Yep, exactly. Okay, for our third scenario, let's say that you donated all $600,000 worth of appreciated stock. Well, you are going to bump up against the 30% AGI limit. That's the max that you can put in of appreciated stock. It's actually what we talked about last time, where there was that 50% limit. It's the lesser of the 50% limit or the 30% limit for appreciated stock. Are we all confused yet? Yes, I'm sure. You literally have to go through the software to see it in action. So Ryland, Mr. Grace here, has donated $600,000 of appreciated stock. He's getting capped out at 30%, so only 300% is deductible, minus the $5,000 AGI floor. That hasn't changed, meaning his deduction is now $295,000, and he gets to carry forward $300,000 worth of unused capital gains into the next year or 4 years after that. Okay, as a bonus, I wanted to talk through what it looks like funding, say, a private foundation in the year of a business sale. So given our example, let's say that Ryland Grace here, this first column on the left is our base case. He sells a business. He was still making $1 million, and he sold his business for a $99 million capital gain. Maybe he, put $1 million into it at the beginning. 25 years later, it's grown, and he sold it for $1 million. So he paid a $99 million capital gain, putting his total income at $100 million. Again, just trying to use round numbers to keep things simple here. If we jump down to our taxes, you can see that he would pay almost $24 million worth of taxes, which would be a big, hefty bill. Now, if he is doing this and he also wanted to fund a private foundation, let's jump through to that scenario. Obviously, he had $100 million AGI. The max that he could put into a private foundation would be $30 million. So that's the 30% AGI limit minus the AGI floor, means he can deduct $29,500,000. Now, why would someone do this? Obviously, you would do this if you are charitably inclined, but the second benefit, if we jump down to the tax section, is that it saves him almost, $6 million, close to $6 million worth of taxes. So that is why, obviously, people are funding these foundations in the year of a business sale, because they're trying to reduce the tax bill in this large income year. And then also they're planning on funding a charity anyways. So this is just a great win-win situation for the Grace family.
Yeah, that's a lot, Stephen, and lots to dig into and think about for sure as we think about tax efficient charitable giving and how the limits and the organizations and and all of that work together to play out. How should our listeners think about some best practices? We have different organizations, we have different limits, we have different property types. If someone comes to you and says, okay, that's a lot of stuff, what should I do about it? What would you say are kind of the keys to focus on or some best practices to take home?
Yeah, I'd say 3 main takeaways. Number 1 is focusing on timing of when you donate. You need to do it in a high income year, whether that's a business sale, maybe you sold a property, maybe you got a big bonus, or you realized some stock options, something like that. That is the year that you want to make the donation. Number 2 is donate appreciated stock. That should probably be the first bucket that you pull from. Yes, you have a lower limit, so 30% of your AGI, but what we typically see is no one's usually kind of coming up against that ceiling, unless obviously they're trying to fund something much, much bigger and have a kind of a bigger vision for their gifting. But in most typical years, you're not going to run across basically running against those limitations. So you should take advantage of the double tax savings. So you get the tax deduction, the income write-off, and you save money on the capital gains tax. And then lastly, number 3 is using a donor advised fund. If a private foundation maybe isn't something that you are interested in at the moment, a donor advised fund is a great alternative. It's much cheaper. And the benefit of that is when you donate appreciated stock to it, you don't have to grant the money in the year of the donation. You can actually divvy out the money in future years. So it's a great way to fund it in a high income year and then wait to make your grants to different types of public charities in the future. So I would say those are the 3 main takeaways. And there you go. There's charitable giving.
Thank you, Stephen. There you have it, folks. Charitable giving, IRS limits on income, property types, and charity types. And this was really good, Stephen, really helpful. And thank you to Kevin, our editor, and thanks for listening. We will see you guys next time.
Like our perspective about wealth? You can explore our approach at birchwoodcapital.com. We work closely with high net worth families to manage their wealth and create thoughtful, customized plans and strategies. The information in this podcast is for general, informational, and educational purposes only. It should not be relied upon for any investment, financial, or any other professional advice. The opinions expressed by the hosts and guests are their own and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the loss of principal. Past performance is not indicative of future results. Consult with a qualified professional before making financial decisions. Thanks for listening.